morning. My name is Kelly McCormick, and I'm the Director of Events and Programming here at the Portland Regional Chamber of Commerce. Welcome to Growth Basics for Business, a monthly breakfast seminar series that provides a forum to gain useful, do-it-yourself workplace solutions and insightful, actionable tips. Today is our fifth event in the 2025-2026 series, and I want to thank all of you for joining us this morning. We're excited to announce a new sponsor of this program, Chubb Benefits, to whom we are grateful for providing relevant content and support for this series. Today's topic, Voluntary Benefits, a strategic solution to rising healthcare costs, will be presented by Stephen Corriveau, Northeast Zone Vice President, and Wendy LaPrise, Agency Director of Combined, a Chubb Benefits company. We'll explore how voluntary benefits can help your organization address the challenge of rising healthcare costs while enhancing the financial security of your employees. Like all Chamber's virtual signature events, today's presentation is free and is being recorded. It will be made available for free replay on the Chamber's website and YouTube page. To keep up to date on all the Chamber's news and events, visit our website, portlandregion.com, and follow us on Facebook, Instagram, and LinkedIn, and sign up for our weekly newsletter while you're at it. Before we begin today's program, I just want to remind everyone that we're using a platform called StreamYard. This platform provides improved production and interactive elements that enhance our virtual events. If you have any questions for our presenters today, you can type them in the YouTube chat throughout the presentation. Stephen and Wendy will answer them when appropriate, and we've also reserved time at the end for Q&A. All this to say, please do interact with us this morning and ask questions. With that, I'll hand things over to Stephen and Wendy to share more about their work and provide today's presentation.
Great. Good morning. Thank you very much, Kelly. Appreciate it. Good morning, everyone. Hope you weathered the storm wherever you may be. Hope everyone's having a great Tuesday morning. We're thankful and privileged to be here this morning to give you a little bit of insight on voluntary benefits and the impact, not only the industry itself, giving you a little bit of background on that, some insight into the industry, but also how these voluntary benefits can help your business, your employees, from a recruiting and a retention standpoint. So why don't we get started? So first thing I'd like to do is give you an industry review, a little background of what are voluntary benefits and how do they what are some of the key driving measures and how it's tackling increased medical costs. So as you see right here, this is a chart that shows medical conditions that have been driving cost over the last 3 or 4 years. As you can see, cancer is the biggest. All the way down through heart conditions, more common, different stages or levels of diabetes, mental health, digestive issues, and then all the way to the right, maternity. But we do see that the number one and number two for conditions, medical conditions driving the cost of medical care, being cancer and musculoskeletal conditions. The biggest jump that we've seen has been cardiovascular, and really leveraging, as you may know, it's kind of a hot button right now in 2025. It really kind of took off, was GLP-1s in the industry itself. So those are really the driving things in healthcare, where a lot of business owners, a lot of employers are trying to figure out, what can we do to kind of curtail the rising costs of medical insurance or premiums associated. Voluntary benefits in the industry itself has experienced historic growth just over the last 10 years. We've seen right around 9.3 billion, or 6.7% growth within our industry, and that has yield for us as an organization to have 53.5 billion of in-force premium. Now, why do I tell you this? Because we're just one company being Chubb in the midst of several other carriers, but it just shows that significant growth over the last several years. Top voluntary benefit products, which we'll go into a little bit deeper industry, are accident insurance, critical illness insurance, short-term disability insurance, life insurance. In here, we see term life really taking off, dental insurance, and other notable benefits such as hospital indemnity and vision insurance. Voluntary benefits, as a review, voluntary benefit sales are at a historic high. Growth for 2022 was over 5%, and growth for 2023 was nearly 7%. We've continued to see those trends in the industry in 2024, and we should be getting 2025 results. But you'll see a steady growth in the industry where all different size businesses are looking to add these to, again, kind of curtail the rising costs of deductibles, premiums, co-pays, co-insurance, to really help provide a safety net or a cushion for not only yourself as a business owner, but also to your employees. Over 2/3 of voluntary benefits are sold either directly with the carrier or through benefit brokers. Life products lead the way in most of those sales. As you notice on the chart to the right, 2023 market share by distribution segment, they can be offered through health insurance benefit brokers. They can be offered through the insurance carrier directly. And they can also be offered through, there are worksite specialists out there, voluntary worksite specialists that also offer these. But typically, most of these voluntary products are being offered through the benefit broker channel. In 2023, there was a sales mix of products, and that continues to widen the gap. But life insurance, as you can see, with a 30% participation or 30% offering, that tends to be the leading product. From there, disability is at 18%. So just that alone makes up almost 50% of the voluntary benefit portfolio. Now we start getting into, and this is where we're seeing significant growth in the industry, is what I would consider our supplemental health category. And we'll go in a little bit more into detail as we go through today's session. But those products falling under that supplemental health category are things, again, that will help act as a safety net. The rise with the medical premiums that are rising, with the co-pays that are rising, most business owners, most employers are really struggling because you're really faced with one of two options. Either find a voluntary carrier that you can align with these supplemental carriers, which are cancer and critical illness off here to the left, off to the right. Cancer and critical illness makes up about 14% of that product sales mix. Hospital indemnity, which again we'll get into, makes up about 10%, and that's continuing to rise as we head into 2026. Accident insurance, which makes up 12%, and then dental and vision, as you can see here, makes up 12% and right around 2%. But that supplemental health really focused around the first three driving products, which are the cancer and critical illness, the hospital indemnity, and the accident plan. Now, as an employer, you probably face many challenges, like everybody, is the is trying to combat the rising cost of healthcare, enhancing benefit programs within your budget, attract and retain top talent. We see that is huge. It's becoming more and more prevalent in whatever industry you're in as an employer, is attracting and retaining top talent. Most employees will be attracted to a company based on not only wages, but in a very close second, and in some cases, the number one priority of what would attract them to a business and stay at that company is the benefits that are being offered. Communicating the benefits, voluntary benefits. If you align yourself with a voluntary solution, aligning yourself with the right product portfolio and the right carrier to help communicate these benefits, because they're so wide, and you may be offering 2 or 3 or 4 voluntary products that make sense. Having a communication strategy and partnering with an insurance carrier that can allow you to help communicate those benefits. And there's various ways that they can do that, which we'll get into further into the session here. But the biggest part is it improves workplace morale, productivity, and loyalty. Again, this is where you can align yourself with an insurance carrier as a true partner to help increase that workplace morale, productivity, and loyalty. Employees face challenges. 61% of consumers are living paycheck to paycheck. And I would say, having myself been in the industry for over 26 years, that percentage has actually gone up over the last couple of years, really since right around COVID. But 61% of consumers are living paycheck to paycheck, and most of the time, they're one paycheck away from a financial disaster. Employees are concerned about increased out-of-pocket costs and high insurance deductibles. They have limited savings in their checking or savings account. And working for an employer that offers valuable benefits is vitally important, whether it's benefits that are being paid for either partially or in full by an employer, or if in fact they're completely voluntary, they see the value being consistent across the board, regardless whether you as an employer are paying a portion of that or all of it, or whether that product is being paid 100% by the employee. And then they're also concerned about us understanding the benefit choices and the costs. Again, this is where partnering with a voluntary carrier, asking those questions is, how are you going to help partner with us? How are you going to help our employees understand what the choices are that we're offering, and how they can understand the products in a way that they can justify what the cost is on a payroll deducted basis. What voluntary benefits do? They help provide you valuable products to your employees at little or no cost to the company. Now, again, you can contribute a portion or all of those premiums, but in most cases, what the traditional method is that these are truly voluntary, not to cost your organization anything, and payroll deducted out of employees' paychecks. But voluntary benefits can fill the gaps and help supplement existing benefit and medical plans. They help protect employees and their families from the financial strain that come from unexpected medical expenses. They pay cash benefits directly. Again, these are what these voluntary benefits do to the insured or the employee that's participating, to be used for everyday living expenses or out-of-pocket expenses. We know that major medical deductibles rose by a staggering 179% just in a decade between 2010 and 2020. And what we also know is that there's direct costs and there's indirect costs associated with medical deductibles or medical plans. A direct cost would be, for example, what's the out-of-pocket expense of what's not covered under my medical plan, be it a deductible, copay, co-insurance, things that might be limited on your medical plan. For example, chiropractic care, physical therapy. Most medical plans will max out at 10 to 12, sometimes a little bit higher, but for the most part, the average is 10 to 12 for physical therapy appointments and or chiropractic. Well, if you have an employee that, let's say, unfortunately gets into a car accident or needs knee surgery, or they tore their ACL or their MCL, for example, they're going to need physical therapy. And with most medical plans, they're unaware that most medical plans will max out at 10 to 12 visits. Now, I'm sure you can imagine if someone is having physical therapy, let's say for an ACL tear, they'll blast through those 12 copays probably within the first 2.5 to 3 weeks. And typically, they're going every day or every other day. After that point, the medical plan, which most employees don't realize, will no longer cover that. They'll probably still get an in-network discount, but that's a huge difference between maybe a copay of $15 or $20 per physical therapy appointment, now costing them $50 to $60. So it would still be a discount because they're using that in-network on the medical plan to get treated, but a significant increase in that out-of-pocket expense. So that would be a direct cost. What's the direct cost of what's not covered under the medical plan? Well, if you align yourself with a voluntary carrier, these products pay the insured or the claimant, your employee, directly. So they can really utilize those cash benefits however they see fit. Indirect costs would be costs where, let's say, for example, if somebody got contracted with Lyme, for example, and they had a voluntary product, let's just say the accident plan, that accident plan will actually cover them for that time that they're out of work, should they be bit by a tick and contract Lyme. Now they have to pay for lost wages. They might be at home. They might need to hire a nanny, depending on where they are in their family situation. That would be an indirect cost now associated, where even though most of the medical the medical parts of the plan are covered, there's those indirect costs they just don't think of. Aligning yourself with a voluntary carrier where it pays those cash benefits directly to the insured, again, helps with those everyday living expenses and indirect or direct out-of-pocket expenses. It covers loss of income if totally disabled. And again, because it's those cash benefits, whether it's them being covered of their income through a disability plan or using the surplus or the overage of those cash benefit payouts based on the products, where they can just use that to offset as well any additional income that might be lost. And then last, again, just to reiterate, it improves employee morale, productivity, loyalty, recruiting, and retention of that employee. Aligning yourself with a voluntary carrier, also some allow or some offer complementary value add benefits. Why I think this is important is because it adds additional value. It gives employees no direct cost or very little cost to enhance the benefits that they're already offering. Here's just a couple of examples. There are some limitations on the products, on these complementary value adds that a carrier might offer, but the key thing is they do not have to enroll typically in the voluntary product itself in order to receive one or any of these complementary value add benefits. So as you see here, it ranges anywhere from telehealth, AD, complementary AD&D, additional discount programs, ID theft, and other percentage of people that are seen there at the point of the enrollment, where they'll get better or more aggressive or complementary underwriting. And there's different ones out there, but the most common would be guaranteed issue or what's called credit for time insured, which I'll get into that in just a moment. Best approach products. Voluntary products are available for the group or individual through payroll deduction or direct debit and are offered at the worksite. We'll break that down so you'll get some clarity around that, what I mean by payroll deducted or direct debit through the workplace. But essentially, they're group or individual products. They can either be payroll deducted or direct debited directly out of an employee's checking account. But typically, we find that those most voluntary carriers will align that direct debit strategy for businesses where they have employees that have 3 employees or less. Now, the good news is aligning yourself with a voluntary carrier, typically you should look for participation requirements. A good voluntary carrier will have no minimum participation requirements for most products. What that allows you to do, or what I should say, it doesn't put you in a position where you're trying to meet 10, 15, 20% participation. And if that doesn't occur for whatever reason, then you don't have to go back, or the carrier doesn't have, that you partnered with, doesn't have to go back to the employees and say, hey, you only received 18%, you were supposed to get 20% participation, or you're supposed to get 10% participation, you got 3%. It prevents having those after the enrollment's completed. It prevents having those conversations to go back to the employees and saying that unfortunately we can't offer this product because participation wasn't met. So again, aligning yourself with a good voluntary carrier as a good partner typically will have no minimum participation for most products. Going into a little bit into detail, again, this is something where if you are looking to partner with a voluntary carrier, some key things to look for. So again, I mentioned that you can either get it offered on a group basis or an individual basis. And just to give you a quick breakdown of what the difference is between those two, a group product typically requires where the employer or you hold the master contract. In other words, instead of the employees actually owning that individual policy where they get a physical policy in the mail, you as an employer hold that master policy. And then within that, it gives what's called certificate of coverages to your employees. Now, a lot of times, group products are not portable, meaning if an employee leaves, they can't take it with them. Or if it is portable, they have what's called a conversion cost. And that conversion cost means that because they're coming out of the group and they're porting that policy on their own, typically that cost can rise anywhere from double to as high as 5 times the cost of what they're used to paying while they were employed at that employer. The other option is individual. Now, individual, although it tends to be a little bit more expensive, there's a lot of flexibility there. There's a lot more choice, more at the employee level, where they can really develop the plan design that fits their needs. So it's very, very personalized. The advantage of that is as an employer, you don't have that master contract. Each individual employee that participates gets their own policy itself based on the design that they chose that fit their needs and their individual cost. Now, both can still be payroll deducted, but it gives a lot more flexibility on the individual side. And should they no longer be at your organization, they have the ability to port that policy for the same cost. So significant difference there. where they don't jeopardize, should they no longer be at your organization, run into a situation where they want to keep the product, but it becomes cost prohibitive. So individual products, although it's a little bit more expensive on the front end, there's a lot more flexibility, and typically aligning yourself with a voluntary carrier that offers the choice of both based on the state. It kind of, again, gives you that flexibility and allows that choice at the employee level or at your level as an employer. So right now I'm going to pass it off to Wendy. She's going to go over each of the products. Again, we're going to break it down. I believe the first products that we're going to go over is our supplemental health, but that's the accident plan. And Wendy, I'm going to pass it off to you.
Okay, thanks, Steve. So when you're talking to a carrier, you want to make sure that you bring in the most robust products to your business. So some of the features that you want to look for, as Steve mentioned, was being portable, that they can take it with them at the same cost, that it won't be inflated when the employee detaches from the company. So you want to look for something that will cover the employee around the clock and not just off the job, but on the job also. Some of the plans that are out there have a wellness feature, which means that if the person takes some kind of a physical, a blood test, normal health type screenings, they get a refund back on the policy once a year per person in their family. So everybody that's on the coverage will also get the same dollar figure refund. And sometimes carriers offer the first time occurrence. And usually a lot of carriers will get that money out to you through a computer right away. So at least getting some money in your pocket to cover maybe some gas or groceries. So it's important that they do have that first time occurrence. And some carriers also have a sports package where they're going to go ahead and increase the actual payout up to a certain percentage or a certain dollar figure if the adult or the child gets injured playing an organized sport, baseball, soccer, lacrosse. Most of our children today are definitely involved in some kind of athletic sporting. So it's important that if that's the case, you want to make sure that you get the extra money on top of the actual claim. Just go to the next slide. So critical care, I think critical care is one of the most popular policies because you'll find a lot of carriers that are going to come to you and they're going to say, oh, we have a phenomenal cancer policy. Well, what happens if? There's always that word if. What happens if they get a heart attack, a stroke? What about Alzheimer's, Parkinson's, multiple sclerosis, heart attack, organ transplants, things like that, failure? This policy covers almost everything that could happen. And it's a lump sum payout. And that's very important because sometimes people, when they get diagnosed with certain illnesses, don't need to be worrying about how am I going to pay my mortgage? How am I going to put the kids' college money aside? How am I going to buy food or pay the taxes? This type of policy is a lump sum payout to the individual, and it's tax-free. You want to make sure that the carrier is bringing this in so the benefit check is tax-free. They get this money, they put it in the bank, and they can just relax and try to get healthy again. And you want to make sure that when you're talking to a carrier that it's more than just heart attack and stroke. You want to bring in numerous benefits that could happen. Go to the next one.
And Wendy, one of the things that I like about this, about the critical illness product as an industry leader, is some carriers offer either a single payout or a triple payout. Can you just explain that a little bit and the difference of what the viewers can look for on a critical illness product?
Yes, Steve's right. Most carriers will offer you a single payout where, okay, I'm diagnosed with a heart attack. Once the check is cut, the policy ends. You want to find a carrier that opens it to a triple payout. A triple payout is, I had a heart attack, but the policy, I got my check, but the policy still stays intact. And now I get another check when I have a stroke. Then I get another check when I end up with multiple sclerosis. So you want to find a carrier that's going to bring you a triple payout. Also, you want to look for a carrier that's going to help you with your rent and mortgage, maybe an advocacy person who can help with transportation, meds, doctor's appointments. It's very frustrating. It's very confusing when something happens. You're not really focusing. So to have this third party help you and guide you is amazing. And most carriers, by the way, don't cover Alzheimer's, Parkinson's, and multiple sclerosis. It's not usually included. So that's something you do want to look for when you're talking to a carrier. You want to be able to put this on your spouse also, and you want to be able to offer it on your children. So make sure the carrier does a complete package for your family. And remember, again, tax-free. So this way, when they get the check, they don't have to worry about giving the government half of their check.
Yeah, so you really want to make sure you look at those bells and whistles, right?
Absolutely. Go to the next voluntary. Yep, disability. So disability is really important. It's going to help you. You want to find a carrier that's going to be able to either come in with a 0 elimination period, 14, whatever the needs are. If you have a short term, maybe tacking on a longer term policy. If you don't have a short term, but you have a long term, maybe you want to look at a carrier that can bring in the short term and cover those days that they're sitting home with no paycheck coming in. So you definitely want to talk about the flexibility with the elimination period. Then you want to talk about, well, what happens if I'm hospitalized? What happens if I am out this long period of time? How am I going to pay the premium for this policy? So having a waiver or premium put into the policy is crucial when you're looking at it. This way people don't have to worry on paying that bill. Then you want to talk about, is there a rehabilitation package at the end? Does it cover situations like, mental health and maternity and things like that? So you want to really find out, you want to do a deep dive into this. When does it kick in? How long does it kick in? Do I have to pay the premium while I'm out sick or hurt? And then, of course, what benefits will it pay for and what benefits will it not pay for? So when looking at disability, really do a deep dive.
And Wendy, disability in particular, right? I mean, one of the driving forces for employees, or the biggest question that they ask is, can I still continue this product if I'm no longer here? I mean, life brings many changes. So having that portability and looking at a carrier that offers that portability is huge. The other thing is, people will move from one carrier to another for multiple reasons. It could be a rate, maybe their rates have gone up and now they're shopping around looking for another carrier, or it could be maybe a claim that went sideways, or maybe they just want to know what else is out there to give them a better experience with the disability coverage. So you want to make sure that when you're looking for a voluntary carrier, that you're one of the critical things is this last bullet right here, credit for time insured. And essentially what that means is you're going from the existing carrier over to the new carrier, and you want to make sure that there's credit for those people that have currently participated under the older or the incumbent disability carrier, and making sure that there's no harm that's done for those employees where they would be excluded from transitioning from the old carrier to the new. And that's exactly what that defines it as. That credit for time insured is that basically credits them for the length that they've had under the prior disability coverage. so that they're not impacted by, let's say, a pre-existing condition. If someone's currently expecting, for example, that there's no harm that's done to them, and knowing that they would be covered under that new disability carrier.
And you also want to look at the guaranteed issue, not only for the disability, but the critical care. You want to make sure that the carrier can bring in a guaranteed issue. So if you have somebody that is going through a situation right now, yes, they can buy the policy. They may not be able to use it for the situation right this minute, but after a period of time, a reoccurrence, they would be able to use it, but not, alienating them where they can't even buy the product. So life insurance is very confusing. We probably all know that. You see TV commercials, you see all these ads, and you never know which is the best policy to purchase. So we actually have a very, very good term. Well, most carriers have a very good term policy and a very good universal and a whole life. So what you want to do is you want to really do a deep dive into the product that you're bringing in. Number one, is it portable? At the same price. A lot of policies are portable, but they may not be the fixed same price that the individual purchased it at. You'd hate to see them now jump from paying something that was $20 a pay period all the way up to now paying $100. So again, that guaranteed renewable for life, you want to talk about that. You want to make sure that, it's not something, this particular term that, you might want to bring in to your businesses. You want to make sure that it's not going to end at the end of 10 years, 20 years, and 30 years. And then what happens is the person's out there looking for a policy when they're now 30 years older. So you definitely want to look at something that's going to guarantee them portability and guaranteed for life. And whether the employer pays or the employee pays, that'll be up to you, but there are options, and you want to talk to the carrier about that. And of course, the most important thing is what Steve mentioned earlier, no minimum participation. You don't want to start bringing it into your business or offering it on an individual program, and then all of a sudden somebody says, well, I'm the only one who wants it in here, and now you can't even bring it in. So you definitely need those words when you're talking to your carrier. How many have to participate? If they tell you 20%, 50%, don't struggle. You want to find a carrier that's going to bring in no minimum participation. And of course, level premiums where it's not going to fluctuate, where today they're paying the $20, next year when their age obtained or up another year, they have to pay another extra $5 or $10 because they've gone up in age. So you definitely want to look for maybe some of the policies out there that have long-term care riders connected to them. That is a great avenue because long-term care could be very, very expensive. It could actually be in the tens of thousands of dollars, whereas if you found a term policy with a carrier that has a long-term care rider, that a percentage of that benefit can be used towards long-term care, that's the one you want to bring in. And let's see, anything else, Steve, you want to add with this one?
Yeah, I just want to say too, there are, as you kind of started off and you said term or life insurance itself, when you're going out and you're trying to find what can I offer my employees, whether you have a current plan that's a base plan, one-time salary or a flat 10,000, but maybe you're looking to say, hey, I want to find a supplemental life insurance carrier that will allow my employees on a voluntary basis to get additional. One of the key driving attractions that I've seen out in the industry, particularly with employers, is they want to, again, give that flexibility to those employees. So you really want to look for something that may not just be all the way up to 65 or up until they're employed or no longer employed at your business or with your company. You want something that, again, like Wendy said, is rate stable, that's portable, but also at the point of enrollment is very flexible with the different term durations that are available. You want to look for one that either maybe they offer two different options, a 10 or 20 year, or they might offer three options, a 10, 20, or 30 year. That allows that rate stability to stick at the point when that employee decides, yes, I do need to get that extra financial security for me and my family. And I'm 32 years old, so I want to lock in for the next 30 years. Or I'm 45 years old and I want to lock in for the next 20 years, or whatever their situation is. Having that flexibility at the point of that enrollment rollout, aligning yourself with a voluntary carrier that offers that flexibility, that duration of selection, is definitely key. Let me go.
And also, you want to make sure that they can add their family on. You know, sometimes the spouse is maybe not working and doesn't have any life insurance. Maybe the employee does have quite a bit of life insurance, but nothing on the spouse or the children. So you want to make sure that the plan you're offering is going to open the avenue for family members or children that grandchildren that are legally they have custody of, that they can put them on also. So do a deep dive into which type of product you're going to bring in and ask some of these questions. Hospital indemnity. As Steve mentioned in the beginning with his slides of talking about hospital plans and illnesses, it's super important today with the fact that the medical insurance carriers have really put an increase on their rates, and a lot of business owners have had to turn to higher deductible medical insurance policies to bring them in at a stable price, a price that's affordable to their employees. So the hospital indemnity plan is absolutely a critical plan in that situation because it can offset living that paycheck to paycheck and then all of a sudden getting hit with a very large medical bill and now not having that paycheck. So when you're looking for a hospital indemnity plan, whether it be individual or group, again, you want to make sure it's portable. You want to make sure the pricing is reasonable, and you want to make sure there's a guaranteed issue, because you don't want to be able to bring something in that excludes somebody in your company. Whether, again, it's employer paid or employee paid, you want to make sure there's no minimum participation, and you want to be able to customize it. You know, some of the medical insurance plans have, okay, well, the emergency rooms might be this, but lab work, invasive and not invasive lab work could be this much. So you need to be able to customize it according to what your medical plan looks like. You want to find a plan that maybe offers a wellness visit back per person in the family by taking a health screening, mammograms, pap smears, blood work, CAT scans, MRIs, things like that. So not only on top of being paid for the procedure, they're also going to get back a wellness once a year. And you also want to look for plans that have a waiver of premium. Again, it's very important, just like with the disability, if you're sick or you're hurt and you're unable to draw a paycheck right now, it's very important that you be able to maintain your policies and not have to pay for them. And you want to, like I said, you want to look at what is the highest amount that you're paying out in your medical plan for certain procedures, such as diagnostic testing that I mentioned, or surgery or rehab. So you want to look for plans that are going to help compensate those downfalls, those large gaps.
And Wendy, I know that there are probably some attendees here today that might be, or they may have already gone there, or they may be looking to go there to a higher deductible health plan, or have a high plan that has a high deductible and then still kind of keep that more traditional lower deductible. Now, unfortunately, when I say lower deductible, that still kind of sits around $1,000 of how that's interpreted in 2025, 2026. But I know the next slide we're going to go into is voluntary carriers that have a group hospital indemnity plan. And now that opens up a lot more customization It is a group product, but that one fits more hand in glove with a certain demographic, maybe a mid-sized business owner that might have 25 or 50 employees or more. That's more of a hand in glove solution. But the interesting thing that I like about this is that any carrier that has a group hospital indemnity plan, they also have HSA compatible options, which is huge, because as we continue to see more and more or higher and higher deductibles, we're now seeing employers in the industry go to these more HSA type products. And then again, that goes with even higher deductibles if you've looked at those in the past. So aligning yourself and finding a voluntary carrier that has a group hospital indemnity plan can help satisfy those HSA compatible health insurance options. But if you can just talk briefly on that, just some additional highlights on a group hospital indemnity.
Sure. So you definitely want to find a plan that's going to work well with your HSA and a non-HSA. So you make sure that it's very compatible. Make sure you ask these questions, because you don't want to get into a gray area with payments coming back to the employee. You also want to talk to the carrier about custom plans. Again, we talked about looking at your particular medical insurance and what you're offering. I mean, some of the carriers have soup to nuts. Even they'll pay for a pet sitter to come into your house while you're hospitalized. These plans are going to be a little steep. So you really need to look at what's going to be the most important features you're going to bring in to help offset these out-of-pocket expenses. So you could get, benefits from 7 benefits you offer them all the way up to 40 or plus benefits. So you really got to sit down and see what's pricing and what's going to be the most compatible for your medical insurance. So you definitely want to design that plan with the carrier. You definitely want to look for spousal coverage and children. And most carriers, just like medical insurance, the child at age 26 goes off onto their own plan. So just make sure that any child under 26 will be eligible for this plan also. Again, guaranteed issue. You definitely want to look for guaranteed issue, and you want to look for possibly composite rates where it stays the same. Greater flexibility, and of course, renewable and portable. We absolutely want to make sure that they can take this with them, because maybe they're going to go on to a company that has a medical plan that's even higher out-of-pocket expenses. And this way, they at least get to compensate for the big bills that'll be coming in when somebody ends up hurt or sick. Anything else, Steve, you want to add to the group hospital indemnity?
Yeah, nothing in particular here, but I will say that we're gonna pivot a little bit here on our next slide. So I think it's a good segue where this one in particular, traditional group hospital indemnity products, as you can see, they're for that mid-size employer that's really looking to help fill in the gaps. Again, hand in glove method to really design this an indemnity plan to help fill in those deductibles and copays. But we're going to switch gears in our next slide. We may have some people, some members on this call during this session today, where maybe you're a smaller employer, self-employed. Maybe you have 1 or 2 employees, not counting yourself. So aligning yourself with a voluntary carrier that offer individual. So what does it look like for that maybe self-employed, that sole proprietor, maybe a couple part-timers, non-traditional workers, aligning yourself, finding a voluntary carrier that can also satisfy that business owner that only has a couple of products. So Wendy, if you can maybe talk about this a little bit.
So yeah, individual products just mean there are some underwriting questions as opposed to group products. Group products are going to be a lot more liberal, but you don't want to discriminate against the individual sole proprietor or a business that has under 3 employees. You want to be able to bring these type of products in, as Steve was saying. So you want to find a carrier that can give you the same group coverage, but on an individual basis. And the cost might be a smidge higher, and there might be a smidge more of underwriting, but at least that you would be eligible for the same type of products. Usually individual, it's going to mean non-payroll deduction, which means it's direct bill. There's no big deal. Everybody does auto pay today. It's just, it's setting it up in the system, and it's a very easy process. So you just want to make sure that, they're not going to be you're not going to be sent a bill once every 3 months or once every month, unless that's what you want. But you want to be able to have the direct billing. Minimum 1 plus proposed insured. That's what individual products do. It just means that you are the sole proprietor. You want this coverage. Why shouldn't you have it? You can. You just got to find a carrier out there that can write the same products we've just gone over with you on an individual basis. And let's see. I just feel that you really want to find somebody who's gonna really put this in perspective for you. Whatever's the most important for you, whether you have a mid-sized business, whether you have a large business, or you have an under 3 business, you want to find the right products that will, at the right cost, that will work well for you. And you want to be able to keep these for as long as you're working or into retirement. So those are very important questions when talking to the carrier on an individual basis or on a group basis.
Thanks, Wendy. Appreciate it. So I'm going to take it back now, and I'm going to roll the curtain back a little bit and give you some insight from an insurance carrier's underwriting expectations. So as you can see here, I broke it down into basically 2 segments, small to mid-size businesses and larger accounts, which, as you can see, that would be 250 employees or more. So a good majority of voluntary carriers that businesses are partnering with tend to fall in that small to mid-size, again, as it shows here, 3 to 250 employees. You still want to align yourself with a carrier, and it will be underwritten typically as a guaranteed issue at some level. It doesn't mean that all of the selections or all of the products at whatever level of coverage or option will be offered on a guaranteed issue basis. But from an underwriting perspective, you should at least look at a voluntary carrier if you're a small to mid-size employer that's going to offer some sort of guaranteed issue at a certain level of coverage. You want to make sure that there are typically pre-approved rates, which if it's a good insurance carrier, from an underwriting perspective, they should already pretty much have pre-approved designs that are offered on a guaranteed issue basis with also competitive or pre-approved rates. So that allows a lot of transparency, not only to you as a business owner, but also allows that transparency all the way down to the individuals, the employees that are getting those coverages. The underwriting, the turnkey, it's typically automated. So which means from an underwriting perspective, they've already designed what the options are. There's some flexibility and choice involved, but that underwriting aspect of it has already been approved of what's being made available. What that basically means to you is that there tends to be less back and forth with proposals, with RFPs, requests for proposals, when you're looking to narrow down and say, am I getting the best option? Am I getting the best rate for me and or my employees, a good voluntary carrier will already have that from an underwriting perspective, already labeled out, already carved out to make it very turnkey for you. What that then allows is a much, much faster installation process that could either be done either that week, the following day, or in some cases that same day, based on maybe a time constraint that you as an employer might have. So I want to talk about enrollment technology. How do these products get enrolled? Is that owned by you as an employer? Like, are you going to have to enroll your employees or yourself into these products? Well, aligning yourself with a good voluntary carrier, they'll have an enrollment strategy already in place. And these are just a couple more common benefit administration systems that should have that voluntary carrier's products already built into these benefit administration systems. The two most common in the marketplace tend to be Employee Navigator and another one called Celerix. But these enrollment platforms are typically should be offered at no cost. From a support standpoint, we get a lot of business owners in the industry that tend to say that their time is limited. They might be doing HR functions along with payroll, along with 3 or 4 other things, other hats that they're wearing. So finding a voluntary carrier that can provide that dedicated support to help you during those enrollment rollouts, and typically that's done by one of 3 ways, or collectively, face-to-face, meeting with those employees one-on-one. We call it in the industry benefit communication, and that can be done face-to-face. It can be done telephonic, or it can be done through a self-enrollment. You also want to make sure you align yourself with a voluntary carrier that's going to handle or have a strategy for new hires, maybe off-cycle. In the industry, obviously, there's acquisitions, there's mergers. So having an off-cycle strategy partner is critical. Annual enrollments and lifestyle benefit changes. You want to be able to have that flexibility with a partnered voluntary carrier to help along the way, not just during that initial rollout. And then last is multi-state, multi-location. You don't want to be in a position where you align yourself with a voluntary carrier where they are treating maybe your corporate office or your home office as face-to-face, telephonic, or self-enroll, and then find it where the multi-locations are being neglected. So you want to have consistency there and making sure that the voluntary carrier that you align yourself with has that bandwidth to create a great enrollment experience for everybody. Customized materials. You want to make sure that aligning yourselves with a voluntary carrier that they're going to provide all of the marketing communication to kind of get that communication out to your employees in a timely fashion. And then microsites and pre and post communication. So again, aligning yourself with a carrier that's going to provide all of that functionality and all of that advertising and marketing so that that doesn't fall exclusively on your shoulders. We're almost done. I want to just wrap up with a couple of case studies. So case study number 1, this employer had roughly about 294 employees, and they were way below participation with another voluntary carrier. They aligned themselves with a voluntary carrier that provided credit for time insured and increased participation to over 95%. So really showing the value of having an effective communication strategy and aligning yourself with a voluntary carrier that can partner with you. Second, a client in the industry, 560 employees. They also struggled with just participation with an existing carrier, and the premiums were rather high. They aligned themselves with a voluntary carrier that could help both of those angles, getting lower costs and aligning themselves with a carrier that could help increase employee participation. And then the last was a 260 person employee, again, low participation, but also a communication strategy. And by partnering with an effective carrier, yielding a much higher employee participation and employee satisfaction. So that concludes our call today. Wanted to open up if anybody had any questions, either on the industry itself, any insight into the products that Wendy and I went over, or really just any questions that you might have. So looks like we have just a couple. How many organizations measure ROI when implementing voluntary benefit programs? So that's key, right? So I would say organizations themselves that measure their return on investment when implementing voluntary benefit programs, typically that comes by the reception that is being talked about during that initial rollout and ongoing rollouts. But there are some carriers that if you partner with, they'll actually do a survey at the end. It's very private. We don't ask for typically a voluntary carrier won't ask for names, but aligning yourself with a voluntary carrier that has that ability to do a survey at the end, I think that's critical, because that will give you what you're looking for is, did this make sense? Are my employees happy? Was it a good choice and direction that we made by offering these voluntary products? Next question, do any of these coverages or options differ depending on size of the business? Would one be better for a small 3 to 10 business versus a large 50 plus? So I would say the biggest driving factor are two things. The larger the business, the larger the business owner with the number of employees, there's power in numbers, right? So two things are going to occur. One, from a rate standpoint, you're going to get a little bit of a discount because you're spreading that risk to more employees that are deciding whether they want to elect the voluntary offerings. And then the second is from an underwriting perspective. You could get higher benefit amounts. For example, maybe the guaranteed issue on the life insurance on a business that had 50 or more employees, the guaranteed issue on that might be $75,000, whereas a smaller business might be a little bit lower. It might be $50,000 for guaranteed issue. So that's typically where we see the biggest difference between a smaller size business and a larger size business. Great questions.
Great. Well, I had questions, but you provided such a thorough and insightful presentation that they all got answered. This was really terrific. Thank you both so much. We really appreciate you covering the evolving benefits landscape. It's a huge topic to cover. Did you have any final words before we wrap up? Oh. Sorry, 1 second, you're muted.
There we go. Yeah, I was going to say, going back to the first slide that we showed, the industry itself has grown significantly. I mean, gone are the days of $5 and $10 copays, right? Gone are the days of little to no deductibles. I don't see the industry going back to those $250, $500 deductibles on most medical plans. So it's really critical that if you are there now or looking to go there, or maybe being a little bit more creative with your medical plan, it's just as creative of aligning yourself and important to align yourself with a voluntary carrier that can help grow with you to help still have that that good message, that positive message with your employees, knowing that as an employer, you may be making changes on the medical, but you're putting in that safety net by partnering with the right voluntary carrier.
Wonderful. Well, with that, we will wrap up. Thank you again to Stephen and Wendy for such a thoughtful and insightful presentation. We really appreciate Chubb's support of this series and today's presentation. I'd love to thank my colleague, Riley Legere, for helping produce yet another successful virtual event. And last but certainly not least, I want to thank everybody who's watching this morning. If you're interested in continuing this conversation or have any questions, be sure to check your email. We'll be sending a follow-up with links to resources and the slide deck. And I know Stephen and Wendy would be available to answer any questions that you might have, or other folks from the Chubb team who have been present today. So with that, thank you again, and we'll see you on March 24th for our next session, which is going to cover leadership in the age of AI. I hope you all have a wonderful day.